Joining us right now to talk markets ahead of the trading week is Liz Young. She's Director of Market Strategy at BNY Mellon Investment Management. And Liz, what do you think? Is this just a little bit of a pause, or what's really affecting the markets today?
I think it is a little bit of a pause here, and the markets can continue to grind higher through the end of the year. If we keep getting positive rhetoric on trade, we keep getting news on trade that looks good. One of the things that I think could actually surprise the markets positively big into the end of the year is if we actually get a trade deal, and that's what we're still waiting for.
Does it matter on the details, or any trade deal that says this is a truce and things aren't going to get worse, at least in the immediate future, that would be enough?
I think the market's pricing in a truce. So if we get something that's better than a truce, we'll see more of a rally. If we don't get a trade deal at all, or if we see those December tariffs go on as scheduled, that's going to be a pullback.
A couple of things that the market's been so focused on. The first would be earnings. The second would be the Fed. Earnings have been fairly decent. What do you anticipate for earnings, let's say, beginning of next year?
So you have to define decent, though, because earnings scaled a very, very low wall.
I guess decent compared to expectations, I should say.
Right, decent compared to expectations. And then the other thing that you can look at is the number of companies that beat is higher than normal, but the magnitude that they actually beat by is lower than average. So we didn't actually beat by anything that was that surprising. We just had more companies that I think underpromised and were able to over-deliver. As we move forward and earnings expectations are a little bit higher, it's going to be tougher to scale that wall. And anybody that misses, I think, is going to get punished more than beats would get rewarded.
So next year, earnings projections are currently about 8% growth year over year, and the forward PE is about 17. That feels cheap, if anything. Is that 8% really going to materialize, or are we going to see that 8% end up being 4, 5, 6, and that's why we're trading at the 17 level?
I mean, usually you see earnings expectations come down as we get closer and closer. I would be happy with anything that's about average, and average over a long-term history is about 6.25% growth. So if we can stay above 6%, I think that's good for the market and the valuations are fair. If we start dropping below that 6%, we're going to see the market get disappointed by it.
And do you have thoughts on European stocks? So Europe's trading at 13.5, forward PE much lower growth expectations, but it feels like things are getting a little better. Is there any catalyst you can think of where we could see European stocks really catch up?
Yeah, it does feel like things are getting better. What I've heard a lot of clients say is that Europe is cheap, so we should buy now, but that doesn't necessarily mean it can't get cheaper. We need some of these headwinds to come off, and then I'd like to see Germany do some fiscal stimulus. If that happens, I think the European market gets surprised positively, and then we see maybe a little bit of a comeback in 2020.
Great, thanks.
With interest rates, 10-year today at 1.95%, that's a long way that we've moved very rapidly higher on yields. Does that concern you?
No, it doesn't concern me. I actually think it is good news. And a steepening yield curve, look, the yield curve has been steepening since the beginning of September. A steepening yield curve doesn't get nearly as much news press as a flattening yield curve or an inverted curve does. And as the curve steepens, you get some of those sectors that were hated all year to come back. So financials have run very quietly kind of behind the scenes for that whole period. I think a 10-year that continues to go up is actually good for the economy.